And as a reminder, we are now recording. Anyone with their camera and/or microphone and any chat that occurs for the duration of this class is consenting to have their image, voice, and words used for the Kingdom YouTube page, the MOIS website, and other uses, SCA uses. Thank you so much. I'm turning this back over to our teacher, Richard.
All right, hello, and welcome to A Brief History of Accounting. Let me bring up the PowerPoint, and we'll get this started. All right, so now it doesn't even give me an option. Set a window. This is excellent. All right. One moment while I figure out how to share this. Set now a window. That is not the full page, right?
That is the SCA harassment and bullying policy.
But is it everything, or is it just like my PowerPoint edit view?
It's just the PowerPoint slide. We don't see the edit stuff.
Oh, okay. Well, that's exciting. But I think I want to show the other one anyway. All right, everyone. I'll get this. There we go. That's the whole page for me. Okay, so reminder of the SCA harassment and bullying policy. People engaging are subject to sanctions. Please read this notice and follow it. It's important. And we're continuing. So I'm Richard Heyworth. I'm in the Barony of Carolingia in the East Kingdom, and I'm presenting this brief history of accounting. This came from about a month ago. I ran a presentation on banking and usury, and at the time, people had asked me if I was going to be including some accounting in it. When I was designing that banking course, I started putting some accounting in and then realized that to actually get into the history of accounting would double the size of an already hour and a half presentation. So it needed to be its own presentation, which is what this is. So we'll be going through a lot. This class is going to be taught in 4 sections. I will break for questions after each section. If you have questions, please put them in the chat. Elena's going to be batching them up. She will ask me the questions on your behalf. I will answer. Once we get done with everything, I will close out the PowerPoint, go back to the camera, and we can open it up for just a regular question and answer session where you can just freely ask questions as much as you want. I don't promise to know the answers to all the questions. This is my first time teaching this class, so I'm sure I'm going to be imperfect in a number of ways, but I'm going to make my best attempt, and I will certainly look it up, the answer, and I will post it to the event. So if you have liked this event or going in Facebook, you will get a notification. I will also post there the YouTube link to the East Kingdom YouTube page once this gets posted, the recording, so you can share it with all your friends who are all anxious to hear about the history of accounting. So there's 4 parts. First, we're going to do a quick overview of modern accounting, and that's mostly to catch everybody up on terms and basic things I'm going to be discussing, so that when I say, and then we started using this, I'm not saying something out of nowhere for those who aren't accountants. Then we're going to go into ancient systems. Like I said, this presentation begins in 8000 BCE. It predates writing, it predates counting. In fact, there's a pretty credible argument to be made that writing and counting were created for accounting before they were created for any other reason. We're going to go into Roman bookkeeping and the medieval charge and discharge account. And then we got a section on double entry accounting, which is what we call the modern system we use today, and in its creation in the late medieval, early Renaissance period. Many of you probably have heard the date is 1494, and Pacioli, if you've perhaps heard that name, he is the picture on the front of this presentation and on the Facebook event. But we'll see that it's more complicated than just that. All right, so we're going to dive right in. When we get to the end of our quick overview, if you have any questions, that will be the time then. So we're first going to start off with accounting's definition, because that's how you start off these things, right? So Merriam-Webster says it's the system of recording and summarizing business and financial transactions and analyzing, verifying, and reporting the results. Also, the principles and procedures of the system. But I like to think of accounting as a system that's going to answer 2 questions that we have that we want to know when we're running a business or a kingdom or anything. What stuff do I have? And who owns this stuff? Or if we want to put it more like on ourselves, is it my stuff or is that someone else's stuff? But I have this stuff. And so you think of it like accounting is a list. It's like I have this list of things, and these things belong to my neighbor, these things belong to me, these things belong to so-and-so. And so that's what accounting is designed to answer that question. And it has been doing that for a long time. So when we think about stuff in accounting, we use accounting terms. So we're going to introduce our first term. Our first term is assets, which is the name of stuff in accounting. And so we list all the assets to answer our first question, right? So if you were a bakery, for example, you might have $1,000 in cash in your cash register or in your bank account. Accountants consider that to be the same thing. You might have basically say $200 worth of flour, some salt, sugar, yeast, all these things, including the bread that you're ready to sell. And then bigger assets, fixed assets, we say in accounting, things like your oven. And I haven't included like the actual building all these things are housed in. You might own it, maybe you pay rent, but if you owned it, it would be an asset and you would list it. So you get the idea that this bakery has some stuff, and this is a list of their stuff and how much it's worth, right? Or how much they paid for it. Based on some accounting principles, we're going to do that. The idea of accounting is you want to keep track of how much this is, how much stuff we have, how much we paid for it, and so we can know all of our stuff. We don't lose track of our stuff. So the second question is who owns the stuff, right? So we've got all that stuff. Well, maybe my bank owns the oven, right? Maybe I took a loan for that bank, that oven, and I haven't actually, it doesn't actually belong to me, right? It's that old joke about how you never actually own your house. You know, you buy a house and you go and you kiss the ground that your bank owns, because you don't actually own it yet. And that's what we're answering here. So accounting uses what we call the accounting equation. Assets equal liabilities plus equity. This is the accounting equation, is the basis for all accounting. And in fact, they have to balance. That's what the equal sign means. So when we talk about balancing, this is one of the things we're talking about. So if you think about what we did with the bakery, we added it all together. We'd have about $3,400 worth of stuff. And if the bakery had that loaned by the oven, then we could put together this equation and say that $3,420 of their assets is equal to $2,000 of liabilities. Liabilities are things you owe. And equity. Equity is things you own. So $1,420 of that bakery is owned by the bakery, or more specifically, typically by the bakery's owner. And then $2,000 of that bakery is owned by the bank as a result of that loan. If this bakery were to go bankrupt and be forced to sell everything, they would have to pay the bank back first, and then they would get the equity. This is basically what I said just a second ago. So the left side is what we have. The right side is who owns it. And it's called a couple of notes on here. First of all, this is an accounting identity. That means it's true by definition. It means you can't quibble with it. There's a lot of things you could potentially quibble with on this, and we've created entire disciplines of economics and finance to quibble with them. But in the world of accounting, this is by definition true. Accounting says, under our system, this must be true. It's kind of like saying 1 + 1 = 2. Math says it's true, therefore it's true, it's an identity. But the other thing to keep in mind is that the bank owns part of our stuff. They have a claim on our stuff because of this bankruptcy provision. It's not that we just owe them money, but if we were to give up everything, we would still have to sell stuff to give the bank stuff. So we can think of the bank as having a claim on some of our stuff, which means that some of that stuff belongs to them. The third thing to keep in mind is that the equity, what belongs and is owned by the bakery or by the bakery owner, is just residual, right? So I take the amount of the value of the assets, I subtract off the money I own, and that's how much money the bakery has that belongs to them. So because that's residual, if the value of the assets goes up, if I have, let's say, more cash in the bank account because I sold some bread that was worth less than the amount that I sold it for, that's going to increase the equity. If I lose money, maybe I have to throw out some loaves of bread because they weren't selling and they got moldy, that lowers the equity, so that lowers the value. So essentially, it's a very simple system to figure out how much money I own of my company based on this residual idea that after I've paid off all of my creditors, I get what's left of the stuff. So it's a very simple way to do it. So at the end of the year, most businesses produce 4 types of accounting reports. They also do a lot more. There's usually like 100-page documents that they'll send out to their shareholders. often with lots of color and flowery words about the future of the company, and then 50 pages of small paragraphs of risks that you're not intended to read. But in the middle of them, if you flip to the middle of an annual statement by McDonald's or Amazon, you'll find, usually right in the middle, these 4 pages. And sometimes they'll group them slightly differently, or they'll order them slightly differently. But fundamentally, we have the balance sheet. The balance sheet is the most ancient report. It is the list of the stuff and the people who own it. It is exactly what we just described as the accounting equation, but it is detailed. And the level of detail depends on the company, but you're going to have a listing of assets and a listing of liabilities and a listing of equity. So it is this very basic fundamental item that's called the balance sheet. The income statement really kind of zooms in on changes in the value of equity. So the income statement is over a period of time, whereas the balance sheet is a moment, right? It happens exactly at this time. This is the amount of stuff we had. A second later, we might have different stuff. So the balance sheet takes place in time. An income statement is a review of a period of time. So you have an income statement for a year, for example, or a quarter. There's a lot of accountants who aren't at this presentation because June 30th is the end of a quarter and they need to get these produced. But it says, okay, this is how much money we made, right? So profit is revenue minus expenses gives us profit. Or if we lost money, we have losses, but this would be in the income statement. It is a summary of the changes here based on buying and selling things, our business. We have the statement of cash flows. This zooms in on the cash of the balance sheet and discusses big changes to that. Usually these are greatly summarized. So we're not going to be talking about, like, I sold some bread. We're going to be talking about all sales for everything generated this much cash. I pulled it from the income statement. And then we also bought an oven because we took a loan. And like we got a loan, which brought in money. We bought an oven, which took out money. It's going to be that level of detail. It's going to be really wide, broad out, but changes in cash. So you can see whether you're bringing in money from operating the business, bringing in money from asking for loans, or raising money from new shareholders, for example. Are you investing in new businesses or new ovens? What's happening to cash? Because cash is going to change, and this is really important because how are you managing it is also important if you're trying to analyze a company. And the final one is the statement of shareholders' equity. We're not going to go into too much detail on this one. This is not very important in this class, but this zooms in on equity in terms of, like, if you pull money out. So the baker, for example, had $1,400, I think we said. If they decide to take $100 of cash and put it in their pocket, that's going to be a pulling out of their equity. They've withdrawn from the business. And we want to record that separate from normal just changes in cash flows, because this is a specific change that's happening from ownership. This also happens if you sell more stock, or if you do a buyback, right? You would have it on the statement of shareholders' equity. It's not too important for this course because it's relatively modern, since we have the corporation, which is kind of a 17th century idea, out of period. All right, so a couple more terms, and then we're going to be finished up with this stuff. One term is bookkeeping. It's often used interchangeably with accounting, but they're a little bit different. Bookkeeping is the act of recording, and then accounting is really, more specifically, the summarization of this information into these documents so that you can make decisions and consider what you're looking at. So very similar, but what we're going to find is that bookkeeping is much older, unsurprisingly, right? We started keeping track of this long before we figured out how to group it and make sense of it. An account, you'll hear accounts from accounting. An account is anything tracked. So cash is an account, flour, right? These are all accounts. And so at the end of the year, you might have a bunch of stuff that has all the changes in the amount of flour you have. You purchase flour, you use flour. You'll add those all up, and you'll get a year-end value of the flour account. So that's all accounting. Accounts mean in accounting. It's just these groups of things I have, stuff I have, maybe loans I own. The journal is a list of every accounting entry. So every time something happens, you write something down. So I'm not converting it to accounting speak here, but you might say I sold 1 loaf of bread for $10. You write that down. That's an entry. The journal is just a series of those entries. And then you convert those over after the fact into the journal. So maybe at the end of the day or at the end of the hour. Obviously, with computerized systems, this is instantly. But back in the day, you might do this only on a time-to-time basis, where you would just take it. You have a ledger per account, maybe a page per account, maybe several pages, maybe a book, and then you copy it over from the journal. So if you sold a loaf of bread, in the bread account, you would put -1, for example, after you were doing that. And then usually you put a check mark next to it in the journal. All right, double entry accounting is what we do today. This is our modern system of accounting. Every time you make an entry in the journal, you have two lines, double entry. So if you use $10 to buy some flour, two things happen. Cash went down by 10, flour goes up by 10. So this gets us back to our accounting entry, right? So we have to balance both sides. We're also going to use terms like debits and credits. We tend to think of that when we do double entry accounting. We teach accounting students that these just be left and right based on the equation. Don't try to think of them too much. They get very confusing, especially because banks use them in a confusing way. But we are going to find out that there's some historical reasons for the words debits and credits that are more specific than they are used today in double entry accounting. But the main benefit we get out of this system is precision. We're looking for math errors that we're going to make. So if you look back at that example of cash going down by 10 and flour going up by 10, if all we wrote was one of those entries, and we wrote down 9 instead of 10, for example, we would just not notice, right? But if one of them, if cash went down by 10 and flour went up by 9, you might notice that that doesn't balance. Something's wrong. You should check and double check all of your accounting equations. There's lots of tricks accountants use. For example, if the error adds up to 9, you probably switch some numbers somewhere, things like that. But double entry gives you this second check. And you can check that not only the accounting equation and your balance sheet balance, but the number of debits and the number of credits also balance. And those are left and right should balance. So there are lots of different ways, essentially, to check your work. That's what this exists for. All right, so that's modern accounting. You might note it was extremely fast. If you're a professional accountant, you're probably screaming at me right now, but I'm going to open up to questions about this so far to make sure we've all got a basic grounding in what we're talking about.
Nothing so far has come up in the chat. I did want to apologize with the format that we're using. We can, or at least depending on people's format, they may be able to see your camera. Richard, just as a heads up.
Oh, I know that. I know that I can see me, so that's why I'm gesturing like I normally do.
Okay, perfect.
So don't worry about that. I'm all good. All right, no questions about accounting, so that's good. Let's jump into some history. So our first section is ancient accounting. And so I mentioned at the very beginning, accounting is old. Accounting is so old. It is so incredibly old. It's older than writing, it's older than numbers, and maybe those two systems came about to facilitate it. So we start this story in 8000 BCE in Mesopotamia. And what we have these small plain clay tokens representing objects. So imagine, if you will, a small clay token of a sheep, right? It looks like a sheep. It's a clay model of a sheep. That means it's a sheep. It represents a sheep. If I have 2 of those, there are 2 sheep. So I could keep lots of these tokens, and they would be my sheep. And if I wanted to trade a sheep with you, I'd give you a token, and now you own one of those sheep. Very, very simple things. And of course, if I have a lot of sheep, that becomes a problem. So maybe I have a bigger token that represents 2 sheep. One of the things we notice early on is that you end up having tokens that mean 1 and tokens that mean more, or tokens that mean a lot, as opposed to tokens that necessarily mean 2 or 3. When we get numbers, obviously we get more specific, and there's a gradual change there. But originally, you just have more sheep, more quantity. But basically, what we're talking about is little clay things you could hold in your hand that represent these things. They're just tokens. In 3250 BCE, we get these things called Bullae. Bullae? I'm not sure. We're going to keep on moving. These are so they're called envelopes by archaeologists. They're these small hollow clay spheres. You can see a picture of one there on the right. That big round thing is a Bullae. And so you put the tokens into the Bullae, right? And so now I have a little collection that says, this is all the stuff I own. This is like my clay purse, right? And inside, I've got tokens meaning some sheep and tokens meaning some flour. And when I own those sheep and flour, they're in my Bullae. Of course, the problem is that then someone can just reach in and take it. So you seal it, right? But if you've sealed it, you can't see the tokens inside. So we need to mark something on the outside. So what you can see on the right here in this picture, what we've done, they took the token and basically just pressed it in. So this is a Bullae that we think is representing a number of cattle. Each of those tokens represents cattle. One of those tokens represents a bunch of cattle. It's bigger, and so you could have a bigger hole. So when you look at this Bullae on the outside, you're like, oh, inside this thing are 3 plus a bunch of cattle. And so that's how this would work. You'd also sometimes see these tokens in different cultures with holes in them and strung together in cords. This is an early form of wearing your money. We will see this come again with coinage, but not in this presentation. But the idea is that you could also just string them from a counting board, and you could see how many each person in the community owned. So there's various ways to keep it. So we have this storage system, and you can imagine it gets pretty detailed. So in the 1920s, we found a Bullae that one Bullae for cattle had these markings on the outside, right? 12 ewes that lamb, 6 female lambs, 8 full-grown male sheep, 4 male lambs, 6 she-goats that kid, 1 he-goat, and 3 female kids. So they had like symbols, and at first you had that stamp thing, but eventually you start getting symbols. You have drawings of sheep, different drawings for different types of lambs or sheep or that sort of thing on the outside of the Bullae to indicate what tokens are inside and what's owned. So you're seeing we're having a very basic system of accounting here. I like to call it, we can call it an input-output accounting system. So for example, if I have a Bullae with wheat and I trade wheat with you, I can take the token out of my Bullae that means wheat, I can give it to you, you put it inside. So you inputted it into your Bullae, I output it out of mine. It moved from one to the other. And this could be, you can consider this very detailed, right? Like this is as detailed as double entry, right? They removed the cash and we added the flour, right? Like very simple, just 2 things change. So it's very, while it's very simple, it does also encompass a lot of very complicated things about transference. Now, there's also a couple things it implies. So the first thing is, you don't bother with this whole Bullae system if I'm just going to give you a bag of flour or a sheep. I just do it. I just give you the sheep. I don't actually need to write this down or have tokens for it. You also don't do it if a whole community is communally owning the sheep or the flour or the grain. If you have a pile of it and everyone can take what they want, that's fine. You just take whatever you want. No need to record this stuff. But let's imagine there's a big central granary. Everybody puts their grain in this one thing, but we can't tell whose is whose. You're going to want a separate recording system outside of the granary that tells you what portion of the granary is yours and what portion is someone else's, right? So as you see at the bottom of the slide, I've kind of indicated this is the beginning of the accounting equation. The granary is the stuff, the assets, and then we have a split up on the right side of who owns this stuff. And the Bullae are answering that question. I have a token. It says I own this quantity of grain in the granary. So if I request it, you should give it to me in exchange for the token, right? Very simple system, but handles this very complicated issue of, with sheep, you can say, well, I own 3 sheep and there's 6 sheep over there and half of them are mine. But you can imagine with a granary that's full of a very fine thing like grain, this would fall apart very quickly. All right, so what makes this a whole lot easier is if we could invent something to keep track of the number of things and we could write down sheep instead of having to draw a sheep every time. Wouldn't that be great? So we do this. We invent numbers, and it makes the whole thing a lot easier. So around 3000 BC, we start getting tablets with numbers and symbols. Here you can see this is some cuneiform. The Sumerians are putting this together. Not every culture is using this, which is why we have some overlap with the Bullae system. Obviously, Bullaes are written like this. We don't have to keep it on tablets. We can write this on the outside of them. So there's a lot of overlap, thousands of years here. And around 2500, 2300 BCE, we get writing where we can put descriptive words, right? So this is also our cuneiform tablet here. And so now we can do much more complicated accounting, right? We have a tablet. Here's an example of a Sumerian tablet. And I'm not going to write it out, but this is a tablet about a lease of cattle, right? This is a contract. This is how complicated we're getting. So we have the same amount of like lambs and she-lambs that kid and that sort of thing. We have a total at the bottom, which is interesting. This is a concept we've now added, addition that we can put together. We can put names for people, write them down, and we can have a contract with witnesses and a date, which hold different responsibilities for this. So we have we're starting to get a really complicated version of accounting that's really keeping track of all these things. So we're getting a lot because we've added numbers and writing. As we get more math, we're able to do more stuff. In ancient Egypt, we have paper, so we have things on papyrus. So we're writing these down. We're training people on how to do this process. Scribes aren't just writing down proclamations by the pharaoh. They're also writing down every movement of goods in and out of various granaries in this giant growing empire. So we have taxation records from ancient Egypt suggesting that they're doing some sort of multiplication. They're creating a tax bracket based on the fertility of the land and the distance from the Nile and the inundation level it gets. We multiply that by the land area and determine the amount of tax they're going to pay. We have records from bakeries in Egypt that do many what we would consider very advanced modern business processes. So for example, you make an allowance for a natural baking loss and calculate, well, we expect to lose this much flour just from processing it. Here's a conversion rate from the weight that needs the amount of loaves, the amount of flour you're going to need for a given size. They've got dilution ratios to control for the proportion of flour and water, all these sort of things. Targets and actual output per individual baker per day are being tracked in ancient Egypt. So you can see that as we get math, we just go crazy with this math, adding a whole bunch of things that we would associate with kind of, you know, modern day labor monitoring practice that we get as a consequence of this basic input-output system and numbers and writing. We can really start to do math and look at, are we operating our business well? We can start answering some of these early accounting questions, not just bookkeeping, but making decisions and learning things from the bookkeeping. So we start seeing that in ancient Egypt. All right, our next stop is going to be ancient Rome, but I'm going to pause for a second and see if there's any questions about these ancient methods, this input-output system.
Nothing in the chat.
Nothing yet? All right, I must be doing well.
Do we have any archaeological evidence to say how often people broke open or whatever these bullaes?
So
I don't know nothing about bullaes. This is great.
So I don't know how often. I suspect that they might have the tendency to be single use because they're clay. So if you broke them open, then you'd have to have another one made. So I suspect the answer was not very much. If they expected them to be used more often, they almost certainly weren't sealed. But since most of the ones we have today were sealed, that suggests that those are the ones that were unused, right, or forgotten or lost or something like that. So how they were used back then, it's hard to tell because of the survivorship bias problem, right?
Mm-hmm. Thanks.
We have another question.
Sure.
How often could errors could occur?
Oh, all the time. I mean, so less likely with your system of clay tablets, right? Like you have a thing, it means a sheep. So that's pretty good. If you're doing a bunch of sheep, that's going to be a little bit harder. That's just a consequence of not having numbers and math. But I'm sure there were some arguments people had. Oh, I have a herd of sheep. Well, one of those sheep is mine, right? You can imagine. You have to keep track of it. When you don't have a better system, it gets harder. When you get into the writing system or the tablet system, you're almost certainly, these are humans, right? They're going to write down the wrong number. They're going to write down the wrong information. They're trying to be meticulous, right? That's their job. But as we'll see, errors are common, errors are expected, and so we start coming up with solutions for errors. So I would expect that means that this time there were rampant amounts of errors. Not to mention just lying, right? Like if you want to make yourself look good, right? Anything else, Elena?
All good.
All right, we'll move on to Rome and medieval systems. So one of the things we see is that the economies in general of the Greek city-states and the Roman Empire are kind of held back by two things that really minimize the amount of economic growth and, of course, the accounting. So we're relying on slaves. This is a real problem. And we have this belief that your wealth should come from politics or family connections or military service. You shouldn't be grubbing for money like a merchant, right? So like the people who have the money to hire accountants aren't largely engaging in commerce. So we're not getting a huge economic boom. We're not looking at ways to improve the economy. We're looking at ways to increase efficiencies. And some of that we're going to get from accounting, but we're not going to have the complexity of the economy that's going to really just demand that accounting get more complicated. But we do get some benefits that cause accounting to get better, right? So first of all, Rome conquers most of Europe. So we have one currency across the entire thing, right? We have a little bit of greater industrialization, right? So now you start having to like account for some different things. My example here is in 54 BCE, you've got evidence that financiers provided investment for Caesar's invasion of Britain and then said, okay, but I want to share the loot after you're done. I want a portion of that. We're going to have to keep track of that with a contract. So we're starting to get some more detailed things across this large empire that we have to manage. But one of the things we'll see, and this goes back to the errors, is the Romans are mostly concerned with whether their overseers, who are of course slaves, were being dishonest or careless, right? They assume the worst of their slaves, and they're looking for ways to catch them so that they can see if they have a problem, right? So that's the #1 reason for most of the advances in accounting in this period is distrust. And we're going to see that for a little bit. We have a textbook by Cato the Elder in the 2nd century who writes a big thing on agricultural estate management and tells us how to manage this stuff. And he calls for, and this is generally adopted thereafter, an annual review where you can compare the results that you wanted to happen with what the overseer says did happen, right? And that overseer is going to put together some lists. They're going to give you the inventories. They're going to put together the tenant obligations, the things that people owe you, right? Those are your assets. They're also going to list all the costs that you spend running the estate. And then they're going to come and give an oral report to you. This is auditus in Latin. My Latin's terrible. A hearing, which is where we get the word audit, right? It's an auditory thing. It's spoken. The overseer would speak it, and of course the Roman noble has their written document in their hand, and they check the oral presentation against the written document and make sure that it's all good, and so that they can check these things. We have a historical extant piece, the Kellis Agricultural Account Book. It's a wooden tablet, and it's absolutely one of the most comprehensive accounting documents we have from this period. And you'll see that it uses kind of a very formulaic approach to group these transactions and present them together. So we're already starting to see this transition from bookkeeping to accounting, where we're not just now analyzing business processes and making decisions, we're also grouping and categorizing so that we can kind of see things in a big picture. This is for a whole year. And you can imagine that over a whole year, the changes on an estate would be lots of vast. If you were trying to look at them entry by entry, it would be unreasonable. So now we're starting to add them together and conglomerate them into something similar to what you might expect to be a balance sheet or an income statement for the stakeholder. We'll see this thing called the Res Gestae, Divi Augusti, the divine deeds of Augustus. So when Augustus Caesar died, he had this placed on bronze tablets outside his mausoleum, and then of course ordered it to be placed everywhere. This is a first-person account of how great he is. But in a very specific section, in the 2nd section, he has an accounting of 40 years of donations that he gave to the people of Rome. So this lists his spending on infrastructure, his grants of lands, all this money he gave, gladiatorial games he was running. It's a very detailed and exacting amount, down to the amount he spent in coin. And so to do this, we can imagine that the bookkeeping requirements, the summary requirements over 40 years over an empire must have been immense. We don't have a lot of the documentation that must have gone into the Res Gestae, but we can imagine that there must have been this incredible amount of collecting of assets and expenditures that was taken over his lifetime in order to have produced this document. There's only a few of these left in the world. There's lots of copies. I think this is a picture of a copy, but I think we have one left in Turkey where the original is still on the wall and mostly readable. Because I wanted this to be a little bit more clear, I used a reproduction as opposed to using the picture I found of the one in Turkey. All right, but so this is when we get really precise bookkeeping, because again, we're really worried about honesty, right? And so we're seeing this everywhere. We're seeing a lot of precision in the Res Gestae, and we assume it's precise and that he's not boasting because we're seeing lots of different places and repeated. But we're also seeing like stores are writing the revenues and costs on the walls of the building, the interior walls of the building. They would put the record of their gains and losses, partly because if you walked in and you saw this precise record keeping that they've been keeping, you know you were in a reputable store. Also, if I do this every year and you see the walls covered in this, you know I've been in business. This is the Roman version of since 1973, right, on the outside of the building, by painting your accounting on the walls. You can imagine that with a large empire and like taxation policies, we talked about the census in the Bible. These are all huge accounting, bookkeeping, precise number keeping, and we're worried about error checking. So we're doing this. But we do get some summary information, but not a whole lot more than we're seeing the Egyptians. So accounting is kind of held back here. In India at this time, we have some evidence in this book, Arthashastra. I can't do this. Arthashastra. If someone else can do that better, please do. But this is written by the Indian scholar Chanakya between the 2nd century BCE and the 3rd century CE. This is going to be a hugely important document for how to run a government, how to run economics, how to do warfare until the 12th century in India. So this is kind of kind of like your big document that was written way back when about how to be the king, right? But important for us is chapter 7 of it's part 2. I left that as X when I went to look it up. But it's called The Business of Keeping Up Accounts in the Office of Accountants, right? So he specifies how you record revenue and expenses for the king. He says you should list all your commodities, which is like your assets, your receipts and your expenditures, which ends up being your net revenues. This is very, very similar to the Roman system that's in use at this time. And there is some overlap between these two peoples. And so it's possible that they were sharing ideas, and that's where you start to see these. He recommends that you check your accountants with addition, subtraction, inference, and espionage. The last one's my favorite. It's indicating again that as a king, you shouldn't trust your accountants. There's this distrust element. And so accounting is starting to be born out of this distrust, which is why we demand an audit to check and make sure that everything's okay. So it's a lot of this record keeping that's built on a very profoundly unequal relationship between the person preparing the notes and the person using them. He also suggests a punishment for accountants whose figures are off, a fine equal to about 8 times the error. So if you're an accountant and you have made mistakes, you can start thinking back to how much that might have cost you if you were an accountant for ancient India. So those are the ancient systems. As we move forward, we're going to move into medieval systems. We start getting things that we call a charge and discharge statement. So the Capitulaire de Villiers, written in the late 8th century for Charlemagne's empire, recommends 2 documents. One is the charge and discharge, which is your revenues and expenses, much like a very modern income statement, or like the record of net revenue in the Indian system that we're seeing. And then secondly, on the back of the charge and discharge statement, you want a listing of all your possessions. This is like a modern balance sheet. So we're starting to see our accounting documents starting to be born here in the Capitulaire de Villiers. It recommends you do this at Christmas time each year and that you give an oral report. This is our audit again. And so that's a little bit the beginnings of our year-end report happening around Christmas time. And we'll see that this gets picked up by European nobles quickly over Europe, transferred to England by the Benedictine Reform movement in the 10th century. So we kind of like start moving this system of the charge and discharge statement across Europe. So if you think about it, if you're a medieval noble, you own a lot of land, but you don't actually have a lot of contiguous land. And that's because the king or the emperor wants it to be that way, right? They don't want you to be able to easily consolidate your troops or your knights underneath your power into an army that might threaten them. So they want to kind of keep you spread out. That's a giant pain for you to manage. So you don't actually manage most of it directly. What you have is you have tenants who run each of your different places. And they might be knights, or they might be peasant farmers, but they run it and they do everything they need to do but run their land, and they just send you money, right? So you get money and rents coming in from all of your tenants, and only a small portion where your castle is or where your estate is your domain, right? This is your area, and you're going to manage and you're going to use it to yourself. This is a hugely complicated system to manage. So you're going to hire someone. You're going to hire a reeve, and your reeve is going to keep track of all this stuff, right? So your reeve is kind of your accountant who keeps track of this. They're also in charge of being the manager of all of this process and maintaining all of it and keeping the domain up and running. It's a very important job as the reeve. Sometimes we'll see this called the chamberlain or such house. It depends on how the overlapping duties are, but we're going to use reeve in this presentation. And so the reeve presents an annual report at Christmas time, often halfway through the year because the noble wants to see how things are going. Often this report is in Latin. And we have this first page, this charge and discharge report. So the charge, the honoratio in Latin, it's a list of all the revenues received by the noble. So these are all those rents that are coming in, right? And if you sell things that you produce on your domain, that's going to be on that side too. The discharge, the second half of that page, the exoneratio, I'm terrible with Latin today, is a list of all the costs. Typically, these are only costs in the running of the domain. It's also the costs that the reeve takes for their services, right? So you're not running any of those tenant places, they're paying rents, but in your domain, you are having to incur costs for the maintenance of it, the running of it, the upkeep of the castle, buying and selling, all that kind of stuff. That's in the discharge report. And then the back of it, we have the inventarium, which is the inventory, right? Our balance sheet that discusses all the things we own. You'd also see a listing of debts that you might owe or debts that are owed to the noble, right? So we're starting to see liabilities popping up in this balance sheet of what I owe and what is owed to me, right? So we start getting that also. So a charge and discharge statement is really getting most of what we would have in a modern system, but it's not double entry, it's single entry. So let's look at what single entry accounting looks like. So Maybe like you go through and you on the 10th of March, you buy some eggs from your neighbor and you pay 20 pounds for it. So you write that down on the charge section. I made some revenue because I sold some eggs. On the 15th, you go to market, right? You sell some grain. You write that on the charge side. 40 pounds, sold some grain. And you bought some seeds while you're at it. So you wrote that down on the discharge side, right? You purchased some seeds. Later on, you purchased some nails to fix Johnson's plow for £1. And 2 days later, you fixed it, and he paid you for fixing his plow, right? So you have all these, and the charge and discharge, you add them up. You've got 70 on the charge side, 6 on the discharge side. You had a pretty good month of March. You made 64 pounds. And so this might be an example of a single entry accounting system, right? So you can see this is kind of based on cash. Sometimes we call this system kind of cash accounting, where you're just kind of keeping track of the changes in your cash flow. And so this would be what a charge and discharge statement would kind of record. Obviously, you would accumulate those over the year for your half year and year end accounts and put these together. But you'll also notice that there's no way to check if you wrote one of these wrong, right? So if you sold the eggs for 19 and not 20, there's no way to check that. You're just going to get to the end of the year and say, well, we should be up 63. And you're going to look at your money and see that you're up 64. And you're going to have no idea where it went wrong. There's no error checking here. And that's fine if what you're dealing with is like a couple of eggs and grain and maybe some nails on a plow, right? We can look this over and we can probably figure out where things went wrong. It gets much more complicated as the system becomes more complicated. But at this time, we also have enough accounting technology to create an exchequer, right? So this gets created in 1110 under Henry I. This is the English Office for Taxation. And it's running basically the job of the reeve for the king, right? So the king has this tons of estates plus their domain. They also need this done. They're taxing all the nobles who are paying rents on their properties, essentially. They keep track of this. We name the exchequer for this 10x5 wooden table that had a little high lip on the side and was covered in a green and black checkered cloth. You can see the picture on the right there. That's where we get exchequer from the checkered symbol on that. And twice per year to do the semi-annual and the annual report, the royal treasurer summons each sheriff from every county, and then they create all of these little small charge and discharge reports that they bring it all up, add it to the royal domain, and we compile it into a big, long list. That list is called the pipe roll, and because it's a scroll, you roll it up, and it looks like a pipe, and you stick it in the little slot. And so we have those from 1130 to 1833. It's a mostly complete document that was generated by the British Crown, and is an incredibly ancient record of charge and discharge that we have extant. There are not as many records like this that exist. Post 1833, the answer is they stopped doing it the same way without the scrolls. They started doing double book entry and that kind of thing. So it's not that they stopped or that we lost the record, it's that the record changed to more modern systems. But this charge and discharge accounting, we have literally 7 centuries of it from Britain. All right. We're almost done with this section, and I'll open up for questions soon. So debits and credits, we've heard those terms in accounting. We get those here. So a medieval merchant, let's say a debit is something he owes. It means he owes in Latin. So that's an amount owed by customers to the merchant. So your customers are your debtors. They owe you. So if I say, okay, you can pay me for the grain next week, they're a debtor to me. I write that in my report as a debit. A credit, which means in Latin he trusts. So that's the amount I owe to a supplier or to my bank, my creditors. So I have debtors to me, creditors from me. So I record those in my books and in my charge and discharge account on the inventarium as money I owe and money I don't. So my debits and my credits. It's where these terms start coming from. Today, we use them much more widely in double entry accounting, which is why I go back to we say they're left and right. But because of some of this basis and like debit being something you owe and credit being something, debit being money you're owed and credit being something you owe, you start getting some confusion in the way banks do things. So they credit your account, they're giving you money because they owe you money. And so they're, as a merchant, recording a credit to your account as more money they owe. When they debit your account with a debit card, that's reducing the amount of money they owe. If they were to owe you, then that would be the other way around. So you can see that that gets really confusing for students of accounting. And so these terms get thrown around. In modern accounting, we say they mean left and right in regards to the equation, but historically, they were used in this way. Debit for people who owe me money, credit for money I We start getting this really standardized by the 13th and 14th century. This is great. This is going great. We got great details. We got headings and subheadings under the charge system and the discharge. And we start seeing some changes that cause this to break down, right? So first of all, the Black Death, we lose a third of Europe, right? And so as a result, the same amount of stuff, the amount of assets is now being concentrated over more people. And that means that there's a large increase in the amount of wealth for the average person, and specifically for the average noble has a lot of money because of inheritances and that sort of thing. And we have this kind of age of prosperity that kind of pops up in the 14th century. And there's almost certainly a prelude to the Renaissance, but we start having a lot of wealth. And so if you're a noble, now you're thinking to yourself, if I didn't just get a fixed rent from my tenants, if I took that stuff from them and I sold it, I could make much more money. And I could get some of these wonderful luxury goods that are coming in, the silks that are coming across the Silk Road from Asia, these nice things that are being purchased. I want more money. And maybe money grubbing is not such an ignoble thing. Maybe the Romans were wrong. And so what we start seeing is that we start getting a very complicated system. Now, we're not just taking in a bunch of rent money and we're spending it on maintaining our castle. Now we're trying to buy and sell hundreds, thousands of goods that are being produced across a holding spread across a nation, all these different things. This gets very complicated. It becomes very error prone. So in the 15th century, we watched the quality of reporting completely collapse. This nice, standardized, very systematic system that had been developed in the 13th and 14th century just completely is no longer serving its duty. Charge and discharge is not enough. We can't use cash-based accounting. And so we're going to need something new. And that's where we're going to break for a moment to ask about Roman and medieval periods. If anybody has any questions about that.
We had a question in the chat. When did these accounting terms switch out from Latin and into French?
So that's really, well, actually, I'm going to say, although I have an answer, I'm going to say I'm not certain. But I think that is a consequence of us being English-speaking and the Norman invasion. So I believe that's when they started using the terms there. Most of Europe is using it in Latin. In England, you're using it in Latin, but they slowly start using it in French because that's a language that you can understand, but your serfs cannot. I believe that's the case from the research I was looking at. I will double-check that, and I will write it in the event once I have double-checked that, but that's what I believe to be true. Although I'm not feeling 100% confident, so I'm hedging myself there. Is that it?
No other questions.
All right, let's move on. Double entry accounting. So here we introduce Pacioli. Fru Luca Pacioli in 1494 publishes the Summa de Arithmetica Geometrica Proportionini et Proportionality. Right. So this is the most important document in accounting history. This is the father of accounting. This is the first published work that details double entry modern accounting. But you might notice from the Latin title, the Arithmetica Geometrica part, this is a math textbook, right? This isn't an accounting textbook. This is a math textbook. We only have one chapter in here, De Computis et Scripturis, which details our double entry accounting. So it's not even what he's trying to do. He's just writing a math book and felt like he should talk about how accounting is done, and accounting happens to be done in this double book entry style. So we call him the father of accounting, but double entry is used for a long time before that. So in his very book, Pacioli is saying it's been used in Venice for 200 years. We have this other author, Benedetto Cutrugli. He wrote a document on accounting in 1458. Wasn't published until 1573, which is why Pacioli gets all the credit, but that's obviously 40 years earlier. We have an extant example of double entry by merchants, Giovanni Ferolfi and Company in Florence in 1211, which is 280 years earlier, right? The treasurer's accounts in Genoa in 1340 are the fullest complete record of double entry accounting. So we have that, the journal, the ledger, the whole deal we have, that's 1340. So you can see that Pacioli is not inventing double entry accounting. He is detailing it in a math textbook almost as just an extra little bit, right? I'm just trying to be thorough in my math, and accounting is a type of math. So he includes it in there. It's the first published instructions for using double entry, but it's clearly not the beginning of double entry. It looks like somewhere between, we see it in 1211 and 1300. It's evolving in Italy, and we get it standardized in Pacioli's text. The difference, and the reason we call Pacioli the father of accounting, is the invention of the printing press, right? This book gets printed and reprinted and spread throughout Europe, and that's where this system of double entry just takes off, right? It stops being this kind of niche thing in Italy and becomes modern accounting. And we'll see slower than it probably should have. So we got some key features of this, right? So Pacioli says the purpose is to give the trader without delay information as to his assets and liabilities. He recommends 3 books: the ledger, the journal, and the memorial. This is kind of a shorthand notation, right? And you'll see, these are the things we're using in modern accounting, right? We're using the journal, we're using the ledger to create all of our accounts and keep track of these sort of things. Pacioli, of course, is writing this as though you already know what he's talking about. So he's here to give you some practical advice. He's going to tell you how to use debits and credits in a modern sense. He's going to tell you how to create these accounts. In fact, typically students of accounting, the very first accounting entry they learn is, I'm putting money into my system, so I'm going to increase cash and I'm going to increase equity, right? That's the very first double entry that most students of accounting are taught. That example is from Pacioli. He uses that example in his text. So it's really how to create the system from scratch. And he's also trying to explain, all right, you've used single entry cash accounting, this charge and discharge, for the entirety life of your business. Here's how you convert. He gives that information because he's trying to help you out that. So he's trying to explain everything about how this system works. And it turned out to be the perfect writing to cause this thing to catch fire. So if we were to write that exact same entry I used about 15 minutes ago for single entry and double entry, it would look like this. So on March 10th, I gained cash and I lost eggs because I sold some and I had 28 each. I gained cash, I sold grain 5 days later. I gained seeds, I lost cash 5 days, nails, cash, and then I had some service revenue, right? So I'm not going to go into what makes a debit, what makes a credit. The key thing to remember here, for those who aren't trying to learn accounting here, is that if you look on the right, everything adds up to 76 here, right? So when I go through and I'm checking these things and there's an error, I have one more thing I can check, right? So I didn't actually do the accounting equation with these, but you could look at how the accounting equation also adds up, the changes to it. And you can see that that checks out and this checks out. So as accounting gets more complicated, you want these ways to check and recheck your work, right? So the debits and credits give me a second way to check. And you can see that debits on the left, credits on the right. That's how we think of it in modern terms. This is how we tend to record things. Because of the printing press, it takes over, and it's vital for the Renaissance economy. You can imagine that the growth of banks in the 14th and 15th century is going to require something to keep track of things across state lines, right? So dealing with different types of currency. In fact, in my banking presentation, you'll see that making money off exchange rates is incredibly important. Well, you're going to need to keep track of not only how much money you've loaned someone, but what exchange rate they've agreed to exchange it at when it comes back so that you can make your profit and not get in trouble with the church. We're doing a lot of stuff. And again, we talked about that direct control of estates by nobles. We have a very complicated system. Complicated system needs error checking. Double entry is the accounting system for error checking. So here's an example. These are the Medici accounting books. This is also my banking presentation because they're cool. These are owned by Harvard Business School, where I happen to work. So I have some pictures that they have made available. You can see on this big one that I've zoomed in, this is a journal from the Medici Bank. And you can see that they're putting the debits on the left side of the page, all the way on the left side of the page, and the credits on the right side of the page. So while we might put them left and right on columns today, they were literally using the sides of the pages to record these. And you can see a little zoom in on the top right of that. In the bottom right, you have a journal, right? So that's all of our accounts alphabetized. So you can flip to a page that's going to show all the changes in various accounts and all those changes. And then you keep one of these or multiple of these per year, but each journal you're going to keep one per year. Each ledger, I'm sorry, the other way around. The ledger is a list of accounts. The journal is the listing of entries. You're going to keep journals as your books run out, right? But you're going to keep typically one listing of accounts and their changes. So this is some pictures of what it looked like. These are from the 15th century. To get to England is a little bit harder. So we have this publication called A Profitable Trees in 1543 by Oldcastle. He puts his name on it. It is 100% just an English translation of Pacioli that he's trying to take credit for. We also see a few years later, Yimpian's a notable and very excellent work expressing and declaring the manner and form of how to keep a book of accounts or reckoninges. He had some illustrative examples. He outlines a balance account. It says to put that at the end of your ledger to mark that point in time. So like what you're doing back in the medieval era with your status, your inventorium, a modern balance sheet. So he says you should also do that in addition to this double entry stuff. And in 1553, we have another book, Peel's The Manner and Form of How to Keep a Perfect Reckonage, which includes the general rule to make things received or the receiver debtor to the things delivered or the deliverer, which is probably the most complicated way that you could explain this double entry system. But he has a lot of examples. And so this book is very important as a reference for accountants in this period on what do I do in this weird outlying case? Peel probably had an example, and so people went to that for the example purposes. We see that double entry is actually very slow to get adopted across Europe. It's got all these advantages, but it's also quite a bit to learn. And so we don't see it getting picked up. In fact, we have writings in the 16th century talking about how shoddy and poorly kept British accounting is in this period and how it's basically just garbage. You're going to see that single entry accounting, charge and discharge style, cash basis accounting is the norm in Britain until the 19th century. This really doesn't get picked up. It's very slow. The Hanseatic League in Northwest Europe likes the single entry system. They like charge and discharge. So everybody who does business with them feels obliged to use it. France uses charge and discharge as a nation state, the late 18th century. The Dutch East India Company uses single entry for its entire existence. So you can see that despite all the advantages of double entry, it's really only getting picked up by the Italians until the 19th century and thereafter. So why did that happen? Well, because what it does is it gives you this high levels of precision and error checking. And many merchants in Europe just don't need that, right? So they're coming together for one idea. They're going to do one little project, and then we're going to split the profits at the end and go our separate ways, and that's going to be all of it. So I don't need to really track what portion of the equity of this business is owned by different people. We're going to need, shareholder accounting before that's needed, and we don't invent that until 1600s, out of period. So we just don't need that. And so if you also, the thing I get from double entry is I can calculate profits exactly in a much more systematic way than just this kind of all the cash I got minus all the cash. But like Britain's taxing land, most of Europe is taxing land. We're not doing income taxes until much later, so we don't need it. Obviously, there is a need for this precision and this error checking for all businesses, but most people are just getting by, and they don't want to spend the time needed to learn accounting in a double entry system. It takes a semester or two in a modern college for people to learn it. You can imagine that's a lot of time for someone to learn a new system than the one that they were brought up with. These things take a long time to be learned. And if you're not doing complicated corporation style accounting, maybe you don't need it. If you're not the Medici Bank doing business across all of Europe, if you're not the Fuggers, maybe you don't need it. And so you just don't adopt it. Okay, so why did Italy adopt it, right? So like the Medici Bank, yeah, but most of Italy is using this really early. Like we talked about the Genoa system, the Treasury is using it. All right, so why? Well, a lot of medieval universities are in Italy. And so we have this educational basis. We know how to alphabetize. We know how to index and subdivide. We're already doing these things well. The business environment is getting more complex, but we're also having interactions with other merchants. So in the Jewish people of Old Cairo, for example, we have a history called the Cairo Genesia, which has evidence that Jewish bankers might have been using double entry accounting as early as the 11th century. The Islamic world seems to have some kind of pre-double entry version before Italy, right? It's not the complete system, but it seems to be some sort of some precursor to it. It's starting to be developed in the Islamic world. China seems to be using a double entry style system in the mid 14th century. They're using abacuses and not using a lot of recordings. We really only have a lot of summary information from China, so we're not sure. But the summary information we have suggests they might be using a double entry system. And so Italy has connections with all of these things. And so they're picking up these ideas, and these things don't seem strange or foreign to them. And so that's probably why they're picking them up early. We do note, most historians of this period note that Pacioli's system that we use today has a lot of unique features from the Islamic system, what we imagine the Chinese. The balance sheet system he puts together is very different from the summary the Chinese are using. And it's really concerned with monetary transactions, whereas those are really also keeping track of other things that don't have any monetary basis. So for accountants, you know that we have this rule where you only record things based on the price you paid for them for conservatism reasons. That's part of Pacioli's system. It's not part of these other systems. So we suspect independently developed, but almost certainly influenced by knowledge of these other systems, especially given the earliness of the Cairo system in the 11th century now. All right, so that's our last topic. So I'm going to open it up, I think, to questions on anything, and I'm going to put my face back on the screen. So any questions about double entry first, and then we'll open it up to everything.
We have several questions
Okay.
jumping in from the chat. So you ended up getting into this already after this question was submitted, but how were these practices of accounting information spreading prior to the printing press? And would it be that the nobility was expecting certain formats of accounting?
So a lot of these practices before the printing press are coming from your Charlemagne era document on how to run the charge and discharge, which is being copied by medieval scribes, by monasteries who are using it. As I said, like the Benedictine monks are the ones who bring charge and discharge to England in the 10th and 11th century. So it's very much the scribal practice of recording this book. And I would say that nobility is probably expecting certain formats, and that's probably a reason that for the slow adoption of double entry is that if your reeve is saying, you know, sir, I've got this great new system, it's going to make a lot more precision, and the noble doesn't know how to read it, well, he doesn't want you to use the new system. He wants you to use the thing that he can check you on, because that's the whole point. Were there schools for teaching accounting? I'm just looking over now because I can read. Almost certainly, I'm not aware of them. I will look them up and I will get some information about accounting education in that period. But given the amount of universities popping up in Europe at this time, almost certainly part of a mathematical education, probably as opposed to a distinctive education, but I'll take a look at it. Do I have any good resources I can point someone at for learning double entry accounting? Not offhand, but yes, definitely, 100%. I will post some good links into the event for people who want to learn double entry. It is complicated. Do we have any information on accounting practices in the Americas at the time? I don't. I can look into that. I suspect that record keeping and archaeology is holding us back there. Almost certainly they had some sort of system. I'm just unaware of it. So that's entirely up to me. So those are all of the questions we have in the chat. I'm going to make one comment as we go out of period. The 17th century is going to get us a lot more use of shareholding institutions, and we start seeing keeping track of the amount of shares you have. So the Dutch start picking up double entry as a result. That's out of our period. And the professionalism of accounting, so accounting organizations and exams become a professional accounting, that's coming in the 19th century, and it's starting in Scotland. For those who are curious about when their professional accounting profession began, is really we're seeing the 19th century there. So early on here, you're really seeing as almost a job you take on in addition to another job. The reeve is in charge of managing the estate and keeping track of the records, so that sort of thing. Okay, any questions about accounting in general?
I have a sort of general question.
Sure.
Much has been made in my general direction of the portraits made in the Renaissance of merchants keeping their books in their fancy clothes and their books in front of them. And then as they got later in period and they would have been hiring accountants, they don't do this. And what do you make of all of that?
I mean, I think that seems very reasonable, right? Like it's a great amount of work to put together your books. And if you're small time enough, you're going to do it yourself and you're very proud of that. It's very similar to the Romans painting their accounting statements on the walls to show how good they are and how precise. But yeah, if you have somebody else doing it, it's not yours. It's not something you're as proud of. You're much more proud of your wealth and the things you acquired. And that's probably happening at the exact same time that this explosion of wealth is happening in the 13th and 14th century. So now in your painting, you're not showing off how good you are at managing your estate through your books and your bookkeeping. You're showing off how good you are at managing your estate because you're wearing fancy cloth and silks, right? That's what I would suspect is going on. You'll also see in the Renaissance, we talk about the practice of putting your wealth in your clothing and sewing gold into your clothing to show off your wealth and to keep it safe, right? So now you have that in your painting. You don't need it in a book, right? So I suspect those are similar things that are going on. I was running a bank at a LARP, but I used double entry. When I ran a bank at a LARP, I did use double entry. But I think if your LARP is sufficiently medieval, I think you could get away with a charge and discharge account and be pretty in period. Although, you know, you'd have to worry about your accuracy. But I think that would be fair. Any other questions? All right, well, I almost made that in an hour. It was a little over an hour. Thank you all for coming. I hope you learned something. I had fun putting this together, and you know, accounting is amazing. So, right, thank you.
Thank you so much for teaching. We really appreciate it. That was so cool. I'm like, ah. I will turn off recording.